What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. Man, am I excited to bring you my guest today, Nikhil Shamapant. He wrote one of my favorite papers on Ethereum called Ethereum, the Triple Halving. And in today's podcast, we focused on why he believes within the next 18 months, Ethereum will see between 30 and 50,000. You heard me right, 30 to 50,000. Grab your pen and paper because you're going to learn a ton about Ethereum. Futures Radio Show is sponsored by CME Group, and in July, micro WTI futures are coming to CME. They will be 1/10 the size of the benchmark WTI futures and will provide traders with a new tool to fine-tune their exposure to crude oil markets and enhance their trading strategies in an efficient, more precise way. To learn more, go to activetrader.cmegroup.com. Futures Radio Show is also sponsored by Trading Technologies, Tradestation, FTSE Russell. The Russell 2000 is a key benchmark for small cap US stocks. Be sure to check out the E-Mini Russell 2000 futures symbol RTY and Micro E-Mini Russell 2000 futures symbol M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. Nikhil, welcome to the show.
Hey, it's great to be here.
Great to have you. I am very excited to speak with you because everyone knows that listens to this show or follows me on social media. For many months now, I've been talking about Ethereum. It's been my biggest position. It's been the biggest position I've had in anything for a few years. And there was a few reasons why it started for me, it becoming a big position. And a lot of it started off with price action. I was watching it and I looked at the way it was in the charts. I liked how so many people were talking about Bitcoin, but not Ethereum. But then I started seeing all these use cases for Ethereum. And I'm like, hey, the headlines are still Bitcoin, but Ethereum is what everyone's using. And then I started hearing people talk about how they wanted to start allocating to it. And some people that I knew weren't even sure how to. And like all of these things lined up. And I said, this seems like an unbelievable opportunity. And then I just became absolutely addicted to reading about it every day. And I came across a paper that you put out that I would have to say is one of the best pieces, if not the best piece I've read on Ethereum, explaining what's currently happening or what's about to happen. And what I found the most striking about it was so interesting is that you don't even claim to be a crypto expert. You say this on your other interviews. You're relatively new to crypto.
Yeah, definitely. I've been learning about investing for a long time, since I was 15, but I just got into crypto last year, right before the Bitcoin halving. Started learning about Bitcoin and then just went down the rabbit hole.
Yeah, that's what happens. It's in your blood now. And before we get into the interview today, I mean, because we say that you're not a crypto expert or you don't call yourself that, I mean, to me, you're absolutely an expert, especially when everybody goes and reads this piece that you put out, which was phenomenal, like I said. What is your background? What do you do?
Yeah, so I just graduated from medical school. So I'll be going into my internal medicine residency in just actually a couple weeks and learning how to be a doctor. And that's what I do full time. I've been investing as a hobby for a while. Obviously, I take my hobbies, I guess, a little more seriously than a lot of people do. But yeah, that's kind of what I spend my days doing. And this crypto stuff is absolutely just an exercise in my curiosity, just seeing how markets work, seeing how crypto markets are developing. It's a fantastic opportunity.
That's one of the reasons why I was really drawn to your piece that you put out, because you're not somebody you're not pumping it. You know, you're writing about this and you want people to have an open mind coming in and reading it, and you just put the work in and you put together a paper on what you're seeing happening in Ethereum and how you think it's going to impact price. And when I was reading it, it was not somebody who is pushing anything. You're just saying, this is what I'm seeing. This is what I think could be happening. So, take note of this. And you mentioned that the Bitcoin halving, I heard you talk about this in a different interview, and you said, I remember buying the Bitcoin halving, and Bitcoin, I think you said, was like up 3% that day or something, and you expected a lot more from it. And then I think that kind of triggered you to go and learn more about the Bitcoin halving and even more about crypto.
Yeah, absolutely. I mean, when you have a theory, someone explains to you how something works, you don't usually just have that one understanding. Usually implicitly you have predictions. Like if that theory is actually how that works, then I should expect to see this. I should be expecting to see that. And when those things don't line up, that should trigger questions. And so it's not that I looked at that and said, well, Bitcoin halving is not real. It's more just that, okay, so the way the Bitcoin halving works must just not be the way I understood it. And when I started digging into the space, honestly, my idea for that, when I talk about how the sell side pressure in a Bitcoin halving reduces, it's not an original idea to me. This is something that people in the space have talked about. A lot of Bitcoin proponents will talk about how the Bitcoin halving can't be priced in. So again, not original to me, but it's just one amongst many explanations that was put forward. And when I saw these things that I wasn't, expecting to see, it started to suggest, okay, certain theories seem more likely to be describing what's going on than others, and that kind of just that gave me a little inroad.
Yeah, and you explain how Bitcoin and Ethereum, I think most people compare the two, and you really go into explaining how they are just completely different, and there really shouldn't even be a comparison.
Yeah, I mean, I think everyone involved in the space, both Bitcoin only investors and Ethereum only investors, no one thinks that they should be comparable. So the only time I see them really treated the same is in two senses. One is that if people don't know the space very well, they'll just kind of buy them both, and the other thing is that speculators tend to kind of to buy and sell them together a lot, and so they end up they highly correlated, and so in those sense, absolutely, like on a historical basis, they're highly correlated, and you need to kind of be careful with that. But because I think they're fundamentally different assets, we can go into the multiple reasons why. I just don't think that correlation will hold up going forward. I think in the long term, the market will reflect their differences more than their similarities, and so that has huge implications.
Absolutely, you nailed it. I think that a majority of the people that are new to the crypto space, which is obviously the vast majority of people at this point because it's new and growing every single day, compare the two of them because of correlation and price. But that is just a bad way to look at things. I mean, for me as a trader and investor, I've learned that correlation doesn't really mean anything. I mean, you could draw a chart of correlation of so many different things that have absolutely nothing to do with each other, and to say that they are the same for an investment or for a trade, I just think is an absolute mistake. So I think that it's important before we get into, we'll talk about the triple halving that you talk about with your Ethereum paper, explain the major differences between Bitcoin and Ethereum.
Yeah, so Bitcoin's major narrative, its use case is to provide a store of value, right? And so the narrative, it's called digital gold. And proponents of Bitcoin will say it's actually better. Digital gold is a metaphor that's being used, but it's actually better than that because unlike a lot of other stores of value, it has a fixed supply in a world where there's a lot of money printing. So if you earn your money in Bitcoin rather than in dollars, the purchasing power of that will hold better than in other currencies. And when the price of Bitcoin rises, what Bitcoin proponents would argue is that having a high quality of store of value is unique in the world, and what we're seeing is price discovery. That as people start to use this store of value, the market cap is starting to reflect the demand for a store of value, right? Ethereum is doing something completely different. Part of what's confusing about Ethereum is that the narrative, the use case is so broad and open ended that when you ask, well, what can you use it for? I have 20 different things to tell you, all of which are not completely mature use cases. So one thing would be that Ethereum wants to be a store of value. This is actually a relatively newer use case. We'll talk about how the triple halving kind of sets that up. But again, is Ethereum today a store of value? No. Today, Ethereum has a unlimited supply. But again, we'll talk that will change. So that's one use case. The bigger thing, though, is that Ethereum has smart contracts, which means that Unlike Bitcoin, which represents these tokens that you can transmit between different parties, Ethereum allows you to, it's called programmable money, and it allows you to actually encode different functions for that money. So this allows kind of the whole world of finance to operate on cryptocurrency. You can imagine a loan where I could give you money, and then automatically the interest payments could be removed on a schedule from your account to mine. You can imagine a lot of like more complex financial products like options and swaps are being just encoded into the blockchain. And then even outside of finance, honestly, the use cases are as unlimited as your creativity kind of allows for. So there's kind of, the skeptical take would be that's great, but we haven't seen any of that use kind of play out in the market. But the more optimistic take would be that this is a technology with unlimited potential, and that potential hasn't been realized yet. The key thing here is that unlimited potential, whether realized or not, it's not something that Bitcoin has, right? And so today, valuing Ethereum the way you're valuing Bitcoin doesn't make sense, because both it is currently not a store of value in the same way Bitcoin is, and it also does have this huge kind of programmable money potential that Bitcoin does not have, right? And so if you think value in the crypto space is 100% derived from its function as a store of value, then you might think Bitcoin is the current winner, and Ethereum in the future might try to challenge that. But if you think that most of the value in the crypto space is going to come from decentralized finance applications, yield providing, various other kinds of applications that are still in development and kind of coming to market, then Ethereum is a completely different asset class than Bitcoin. And what you're buying, the opportunity that you're buying, is completely different as well. And over time, that opportunity should be realized in market price.
I know you say that you're not a crypto expert, but I got to tell you, the crypto experts out there should listen to you and how you explain the difference between the two, because that's an excellent explanation, because it really does define the differences. And when I started looking into Ethereum, that is really what I felt separated the two, the smart contracts and the use case down the road, because to this day, I'm a very small holder of Bitcoin. I buy it here and there, and I'm somebody who's, like I said, I'm not really accumulating a ton of it, but I think that Bitcoin is something I just own as a store of value. I don't know after the price action that I've seen with it, but I'm a trader, I'm a speculator, and I think that Bitcoin still has upside potential. So I buy crashes in it, I buy it small, and I kind of keep it. Ethereum to me has taken my full attention, because I just can't get away from all of the different people I see using it. I mean, you say you're not a crypto expert. I know that I'm definitely not. But the one thing I've been good at over my career is when I see people getting in line to do things that I think are going to have massive impact on society and businesses, I have to take note of that. And Ethereum, to me's potential is amazing. And one thing that you mentioned was smart contracts. And this is something that I've spent a lot of time reading about. And I think it's definitely something that's caused me to be even more bullish on it. One of the primary reasons I am. Before we get into the triple halving, I think it's important that people understand what is a smart contract.
Yeah, so a smart contract is just so in concept, it would be an agreement between two parties that is facilitated by code. So the idea being, let's say that I offer to give you $5 on the next day that it rains. So if we have this agreement, normally you would just hope that I honor the agreement. If we made a legal contract, you could enforce that in like the U.S. court system. But in a smart contract, what you could do is you could have a smart contract where I would deposit 5 USDC, which represents the value of $5. It would sit in the contract, and you might have something that operates on the blockchain. These are called oracles. And all that means is it's a blockchain technology that references data outside of the blockchain. In this case, the weather, for instance. So you'd have an oracle that checks what's the weather today. And it would do that every day. And one day it would say, hey, it's raining today. And that data would go from the oracle to the contract, and the $5 sitting on the contract would automatically deliver to you, right? And so I made this toy example where I'm giving you money when it rains, but you can imagine a variety of applications that are a lot more interesting and efficient. For instance, maybe the value of wine from a winery changes if depending on the temperature, because we know that the grapes have a different flavor or something like that, right? And right now we have kind of like different ways to hedge that out, but you could actually see contracts where, you know, the price of the wine could be changing. Like maybe you say, I want to buy this batch of wine ahead of time, but not if the weather gets really bad, you know?
Yeah.
So you could have that kind of novel contract execute for the price of wine based on the weather. And again, this is just, you can get as creative as you want, but the idea is, in order to execute these contracts in a normal legal contract, you have all these discrete things, and you'd have to come up with a different price for every discrete condition. But when you have the ability to code it, you don't need that to be the case. The way that your variables, in this case the temperature and things like that, interact with the price could all be part of the code in the contract executing itself, and you don't need to go to a bank, you don't need to go to someone else to kind of mediate that. So ultimately a smart contract is just a contract. What makes it smart is that it is automatically executed by code, and that it can interact with data on the blockchain, whatever that data is. And you can kind of make that do whatever function you're interested in getting.
Yeah, I mean, and when I first started reading about these, my brain just started going and thinking about all of the different possibilities with this, and pretty much all of it leads back to Ethereum. I mean, and that's really where I just can't get past the fact that Ethereum, to me, is by far going to be the superior crypto going forward. And like I said, you wrote a paper on this. We're going to take a quick break, everybody, and when we come back, we're going to go over the triple halving and why Nikhil's base case is that Ethereum's going to 30 to 50,000. Hang tight, we'll be back.
Replace your exchange with Tradestation Crypto. Dealing with multiple exchanges is complicated and it takes time, except with Tradestation Crypto. Because we are not an exchange, we are a broker. You have access to multiple pools of liquidity, all in one platform, in one account, one way. Trade crypto your way, plus earn interest on your eligible cryptocurrencies. Get started in one click.
Trade the global markets with Trading Technologies. TT is the world's fastest commercially available futures trading platform, now with integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. Learn more at tradingtechnologies.com. Welcome back, traders. Nikhil's still with us. You heard me right. His base case is that Ethereum's going to go to 30 to 50,000, and the title of this paper is the triple halving. And like I mentioned at the beginning of the show today, I'd already been trying to do some homework on Ethereum, hearing more and more people talk about it. And this paper just really explained so many things. It clarified so many things for me. And I'm actually going to put a link on our website in this post for everyone to go and download it, because I think it's extremely important following this interview that you have this. I printed it out. I haven't printed anything out, Nikhil, in so long. I printed this out because I had to have it next to me, circling, writing. Like I said, it was brilliant. How did you even get started with this? Because there's just so much in there.
Yeah. So as I said, I started with the Bitcoin halving, and then I just started soaking up information on Ethereum. You know, there's so much. If you follow cryptocurrency Twitter, people do a good job of covering things, but I think the space changes so fast on a day-to-day basis that you really just sort of have to let it soak in, try to figure out what's important and what's not. And I started to notice major themes developing that were of particular importance. Things like, does Ethereum work as a store of value? What's the impact of these changes coming up, which we'll talk about, the network upgrades, and kind of like what are the scalability solutions that Ethereum has. So things like that. There's just a bigger picture ideas. Started kind of categorizing the information. And then there was an Ethereum researcher, Justin Drake, who came out with spreadsheet modeling the sell pressure of Ethereum every day from mining right now and what that sell pressure would be after some of the upcoming changes. And so I wanted to kind of contextualize, like, what does that concretely mean for how price is going to change? And once I started looking into it, I was like, oh, there it is. That's a thesis. It's more than just a bunch of new information. I think I can really put this together. So that's how it came about.
Yeah, fascinating. And I want to start off with, let's work our way backwards. I said 30 to 50,000 base case is what you mentioned in there. And take us to the principal reasons as to why you think Ethereum starts working its way towards that price.
Okay. So in my view, the price of Ethereum right now is based on Ethereum as a proof of work blockchain. So what that means is that it works like Bitcoin does. It has miners who are mining new Ethereum and selling that on the market. In the next 6 months, there are two changes to how Ethereum works. One is that whenever you transact on the blockchain, you pay fees to these miners, right? So in July, an upgrade to the network called EIP 1559 is going to cause 70% of those fees to be burned. When I say fees are being burned, I literally mean that the algorithm will delete those fees. And so that means that miners will receive 70% less from transaction fees than they were receiving before. Another change that will be occurring is called proof of stake, which means Ethereum will no longer have miners. It's changing to a different consensus mechanism, which means the way that the blockchain is secured is ultimately changing from miners to what are called stakers. So the way staking works is that to run a node to secure the Ethereum blockchain, you would take some of your Ethereum and you would place that at risk. You'd stake it. And in return, where miners used to mine new Ethereum, stakers will receive that as yield. Okay. And that's a critical concept because this idea of receiving a dividend yield from Ethereum is brand new with proof of stake. And it really changes the value proposition that this will hold to a lot of the larger players in the space. Okay, so how does that bring us to 30 to 50,000? So in my view, from today, you're going to get mid-July EIP 1559, and that is going to burn 70% of transaction fees instead of sending them to miners. Now, the miners have a lot of fixed expenses. They have electricity bills, air conditioning. They run very, very hot when they run these intensive computational algorithms, and their profit margins are very low. And so the miners have to sell a large percent of the Ethereum that they're receiving. So when 70% of the fees are burned, two things happen. One is those fees no longer go to miners, which means that this large player that is dumping new supply onto the market day in and day out will no longer be dumping nearly as much. And that is a tailwind on price, right? Because that's a supply-demand mismatch. It's concrete, and I can even tell you the day that it starts. Like the Bitcoin halving, that doesn't mean it'll go up the literal day that occurs, but it does mean that some percentage of the supply that was on the market every single day will be removed. And assuming no change in demand, price should kind of have a tailwind as a result.
I want to say one quick thing here, so I think people understand this. This was one of the, I would say, light bulb things when you started to talk about supply and demand and how this was going to work with the fees being cut by 70%, is that the miners are getting paid in Ethereum. So they're turning around and selling that Ethereum, which is going onto the market. So when I was reading this, I'm thinking to myself, as a trader, you just look at that and go, and all of a sudden you're losing net sellers. And that feeds into, I'm not going to get ahead of everything, but the lack of liquidity. And there's just so many things that fed into this. And I think that's such an important piece of this that to me on its own, just that right there is going to change really the whole dynamic of how that market's even going to be moving. Because as traders, we're going to be we're used to looking at markets. I talk about this a lot, make a relationship with a market. And right now we're used to that. And I don't know the total amount of fees that are being put out there every day in Ethereum. I know even from my own personal basis, when I'm moving and I'm always like, man, these fees are crazy. And I'm somebody who said to myself, how high can this go? Don't they get priced out, the people that are working on this, if these fees stay at this point? And when I read your piece, I said, wait, that fixes this. Because if that's the case, that really eliminates a lot of the competition that everyone's talking about with Ethereum.
Yeah, no, absolutely. I mean, so many of these questions people have, the fees are too high. How is that possible? They're gonna become eliminated in multiple different ways. That's what's so cool, is there's layers on layers here. So the first thing is, we just recently saw a major price crash in Ethereum, and what accompanies these crashes is a fee spike, right? And so that's why a lot of people will say, sure, maybe Coinbase, a centralized exchange, shut down when Ethereum spiked. But Ethereum's fees went up so high that using a decentralized exchange wasn't much better, right? And it's a fair point, right? The interesting thing is kind of two things. One is, if fees are that high in the future after EIP 1559 is passed, as we crash, that means that as the price is declining the most, we're going to see the largest amount of supply being deleted from the ecosystem, right? And so that means, sure, when the price is down, that's going to hurt, right? But it means on the way back up, when new demand comes back, there will be less supply available to buy in the circulating supply, right? And the reduction in circulating supply is highest when fees are highest. So that's a lot of people were commenting when the price declined. They were like, wow, if EIP 1559 had been passed, we would have burned so much of circulating supply. And that's like a share repurchase, right? It changes the supply demand dynamics on the rebound kind of going forward. That's one dynamic. And then two, and we can go into this kind of later, but there are actually scaling solutions that are coming online to reduce the fees, because even these high fees, we can turn them to our side with the EIP 1559, but ultimately, in order to be competitive with traditional financial products, Ethereum's going to need to lower its fees, and it's going to need to make up that fees on volume, right? So what you need is fees that are competitive with normal credit card transactions, and then you need adoption to be so high that you actually get a large enough amount of fees in a different way. Does that kind of make sense?
No, absolutely it does. And what's the next thing that kind of comes to your mind for one of the principles for this, for this thesis? I mean, because the supply, that part actually to me was the part that it was the clearest to me. Like I said, that was that light bulb. That was where I'm looking at it going, this changes so much. Then there's several other things that you talk about that even add to this base case of 30 to 50,000.
Absolutely. So the first thing is EIP 1559, but at that point we still have miners selling, right? And so I talk about how the way to think about that is the effect of EIP 1559 when it reduces the selling pressure for miners is roughly half of the effect of a Bitcoin halving event. So it's smaller than a Bitcoin halving event. We see this huge effect of the Bitcoin halving on price. So I do expect to see something, but it's not enough alone to account for my entire thesis. So what happens next, though, is that it's expected in November of 2021 is a merge to proof of stake. So right now we have a proof of work system, which means miners have computers running these computational work, to earn new Bitcoin. When we merge to proof of stake, we will shut off all the miners. And so just to kind of pause there, that's why Ethereum is going to have no kind of climate-oriented issues, no ESG problems, because there won't be any miners. So that entire question of using too much electricity is kind of sidestepped on the Ethereum network. And we'll come back to that, right? But the more direct implications is one, when you stake in proof of stake, you'll get a yield. And two, when you stake with proof of stake, You don't have the expenses that miners have. You don't have to pay for electricity. You don't have to pay employees. You don't have to pay for a place to house your computing rigs. And so you don't have that sell pressure. So my estimate is that when you look at the combined reduction in sell pressure between both EIP 1559 and the merge to proof of stake, you should see a 90% reduction in sell pressure from miners. And I want to clarify, that's not a 90% reduction in overall sell pressure, right? That's just a reduction in sell pressure from miners, which is a small part of the overall sell pressure. So again, you're not necessarily expecting, if it was a 90% reduction in overall sell pressure, you'd see a price spike the next day. You'd absolutely would, right? But you're not necessarily going to see that. What you are going to see, however, is this long-term effect, because if miners every day for the last years have been dumping supply in the market, and by January 2022, there are no miners. We've seen 90% less selling from that source. Unless buying drops off, we're going to see a dramatic increase in price. So when I look at the Bitcoin halving, I argue that's where we see the Bitcoin halving come from. Is that initial move, how much of a move to attribute this to, I'm not sure, but whether it's the initial up 50% or, the initial double or tripling, that initial move comes from a supply demand dislocation because miners are not selling as much as they used to be, right? Then other dynamics begin to take over. And in the case of Bitcoin, what we see in my view is that when the price goes up, doubling or tripling, reaching new all-time highs, the narrative starts to take over where people say, okay, Bitcoin is a store of value. You can see the price is rising. This confirms our narrative, and it kind of takes off. So the question with Ethereum is, if I'm right about this initial dynamic, the natural question is then what happens next? What kind of a narrative takes over, and how much potential does that have to drive investor inflows?
Got it. And one thing I want to comment on the sell pressure, and I'm so glad that you made it very clear that it's not getting rid of the selling pressure in its entirety. It's getting rid of the sell pressure that is coming from the miners. Because I think as traders and investors, we all understand that we don't want to get rid of sellers. We need them, right? I mean, that's what actually is going to help, I think, drive price up as well. It's not just getting rid of sellers. It's actually creating, or people that are short. And, this is where futures come in. There's lots of little things that are going on. But I think that that's an important point. The one thing I want to just touch on real quick, too, is that for some reason I was thinking about Elon Musk in this situation because what I am foreseeing, and maybe I'm guessing on this, is that because this handles his issue with the environment, with the Bitcoin mining, Ethereum solving this. I'm just going to be very interested to see what happens when he finally comes to the realization that this is happening with Ethereum. I don't know why I feel like a tweet is coming our way. And that being said, he could say whatever he wants. The fact that he didn't know this going into it is kind of nonsense. But I want to stay on the topic here. But that's just something else I look at and say, that's important nowadays. I mean, you saw what it's done to the price. I mean, people were concerned about it, and this removes that aspect of concern. What's the next thing?
Yeah, so let's skip ahead in time. So now proof of stake is expected in November 2021. So let's look at what things are like in January 2021. So now I want to start looking at drivers of illiquidity. I talk a little bit about the supply shock that we're going to see. So where does that come from? There's two dynamics that are really important to understand. One is in proof of stake, when you stake your Ethereum, you're being given an incentive, which is the staking yield. And in return, you're choosing not to sell your Ethereum. You have to keep it there, right? So the more Ethereum that is staked, the less there is available to buy. And normally when I buy my Ethereum, I might wait and it doubles and I'd be happy to sell a little bit, take some profits off the table. But if I've decided to buy and stake my Ethereum, I have a strong incentive to just hold long term. And you can think about this the same way you think about a dividend yield, where there's a strong culture in equity markets of dividend reinvestment programs, right? This is a known process and it's very mature and it makes sense. Compounding is a significant force. And if you believe in the Ethereum thesis and you have a yield, you're now being incentivized to buy and hold and collect that yield and compound your gains over time. And so if yields are high enough, there'll be a strong incentive to buy and stake your Ether, and that will lock up a part of the circulating supply. So how high could we see that go? So right now, we see around 3 to 4% of circulating supply is staked, and this is in what's called the deposit contract. So as you transition in security model from proof of work to proof of stake, you need some initial stakers, right? So these stakers are receiving a yield around 6 to 7%. Okay, and so that's pretty modest yield. What happens after the merge to proof of stake is that all the transaction fees that were going to miners, the miners are now shut off, right? And so all those fees will go to stakers. And so we're seeing estimates that with fees going to stakers, yields could rise up to 25% or higher, right? So with yields at 25%, in my view, there's going to be a strong incentive to buy and stake your Ether to capture that yield. Whether that's retail investors like me, honestly, just buying the Ether and staking it and exposing ourselves to market price, or whether that's funds that are doing more complex maneuvers to arbitrage and kind of extract that yield without taking on ETH price risk. One way or the other, I believe a lot of Ether will be staked because those yields are too rich to kind of leave alone. Those yields are denominated in Ether. So what that means is if you buy 100 Ethereum, if you buy 100 Ether, I should say, and it has a 10% yield, that means you'll get 10 ETH, right? If the price triples and you have 100 and yield is still 10%, you'll still receive 10 ETH, right? What reduces the yield in this case is not the price going up. What reduces the yield is more people staking. And that makes sense when you think about where the yield is coming from. The yield is coming from the network. The algorithm is issuing yield to pay for security because you, the staker, are providing security to the network, right? So I say all this to kind of show you the incentive to stake is going to be incredibly high. And when you look at what does the amount of Ether staked look like if yields were to get to 7%, which I think is a fairly reasonable number to kind of anchor at. And what I see is 20% of the market cap staked. I'll pause to note I'm also including one other thing in that calculation, and that is that you can use your Ether as collateral in decentralized finance products. So for instance, if I wanted to earn yield on my Ethereum, I could also lend it to you, and I could get a yield on it that way. And so I actually added the use of Ether as collateral to my calculation to kind of understand the amount of supply that was locked, because I view that the same way, where if I'm lending you my Ethereum, there's no way for me to really sell that then. I have to kind of hold that position until I eventually get my Ether back. And so when you add the amount of Ether locked in as collateral or staked together, in my view, we're going to see that approaching 20%, and there's an on-ramp to 30% as well through the use of these DeFi products. And for any asset, when the amount of supply that is locked up and unable to be sold goes up by that significant amount and it gets to 30% of market cap, it means that if there's a source of demand that's buying into that, there's just not going to be very much left to buy, right? Because that's the amount that's locked up. But that's not to say that's all of it. I mean, a lot of people are just going to hold their Ether as an investment, and still normal supply and demand dynamics apply. So if you're trying to buy, who are you going to buy it from? And so that's another kind of dynamic that I bring up as far as why we're going to see kind of unique price action we've never seen before in the kind of coming months.
Yeah, it makes me think it's going to start trading like Bitcoin the higher it gets. As somebody who looks at the Bitcoin book, it becomes very thin when we get really high. You would expect that with also these cryptos, as they higher they get, and there's going to be less volume because they also become more expensive. So you have that going forward as well. So that as a trader, I start to look at this and say, this could be very much of just a real rush of price action higher. And maybe that's why you think it's coming as quick as it is. But the question I have is how is it become sustainable there? Because I think that at some point what happens is those holders, those people that have things staked, when does the price start to work against them to where all of a sudden it doesn't make sense to hold anymore? It's like buying a stock for a dividend. If the stock is getting hammered, I don't care. What are you paying me, 2%? I don't care. So at some point, I'm wondering, is this something you see as sustainable, or is this something you see as up and then down?
Yeah. So when I talk about my base case is 30 to 50,000. I think that's sustainable. And I ground that in a number of different valuation models in my report. But the reason I think that's sustainable too is because, so the yields are not driven by the price moving. The yields are driven by the number of people who've staked. And so there's two things there. One is that if you unstake and you sell your Ethereum, the yields go up, right? And that'll attract someone else to come in and stake. And if price goes up, yields stay up, right? That's a kind of cool mechanism. The second thing is that the yields are coming from fees. And so a big part of this is do I think there will be enough organic growth in the Ethereum network that will actually see enough adoption that fees will make the yields attractive? And I do think so. It's going to be kind of paradoxical. So in order to get that kind of growth, we need to tap into demand for the Ethereum network. And that comes through these scaling solutions. So right now, fees are essentially an auction. In order to get my transaction through, I hit the bid for gas fees, is what they're called. And if I pay a little bit more than you, then my transaction will go in before yours. And the network is always congested, which is why these fees are so high, right? So we're getting these scaling technologies which try to kind of decongest the network and reduce fees. And I won't go into too much detail on how they work, but suffice to say they're coming out in my timeline. So the first release is called Arbitrum, and that's scheduled for May 28th. We're also due to see other scaling solutions coming out mid-July, and kind of in the next few months, we should see them affect the transaction fees on the network. And what that does is it makes it possible to really transact competitively on the Ethereum network, competitive with other kind of more traditional finance products. So what I expect to see, this is why I gave myself until January 2023 to kind of see my whole thesis play out, is because what I expect to see is this next 6 months is the rollout of a number of new technologies. There's the triple halving, the EIP 1559, and proof of stake. But there's also a lot of scaling solutions. And then I expect the year of 2022 to be a lot about maturing of the network, where you see fees down a lot. That doesn't instantly bring demand online, but it should over time. So by the end of 2023 with low fees, I'm expecting tremendous growth in the amount of use of the Ethereum network. And I expect that growth to be, sure, in part by increased speculative activity with newly decreased fees, where people are able to kind of get in and out much more easily, but a large part also in much more organic activity. And I think that should be able to sustain the price at my 30 to 50,000 target.
So basically, you're seeing the use case growing as quickly as a couple of years from now. I mean, in these days, I guess that doesn't seem that long, but I think that's one of the things that for so many people, myself included, seeing how all of this stuff starts being used in such a short period of time. Because like we said, really at the beginning of the show, a lot of what we're looking at with Ethereum is future use case. But you're saying that you believe that all of this is happening within this time frame, which is just a couple of years from now, 18 months really. And that to me, I guess I'm trying to figure out how you believe that will happen to be able to support it. I mean, all of the other stuff, I see all that. I really do have the vision in my mind on how that could happen, but the use case coming and supporting it, that's the part where I sit back and say, where do you see that? I mean, give me some examples maybe of where you see the use case coming into play that would help support that 30 to 50K.
Yeah, so we're already seeing a few examples. Visa came out and announced that they will accept USDC stablecoins, right? So why would they do that? In my view, it's because they view the Ethereum network as a real threat. Because if scaling solutions come out, let's say scaling solutions come out and reduce fees to 10 cents, right? I've seen that as an estimate for the Optimism scaling solution. So if I can pay 10 cents to move money on the Ethereum blockchain, then if Visa didn't do it, then I would just pair a credit card to USDC, settle dollar for dollar with USDC. And now when you're paying, maybe you're a retailer and you're paying 2 to 3% fees on every transaction, I'm saying, no, I can give you a fixed cost of maybe 15 cents and I'll pocket the 6 cents extra. And that's a business model that competes with Visa, right? So Visa announced they will settle with USDC. And that's the first step to integrate Visa, the credit card company, onto the Ethereum blockchain. I believe the reason they're doing that is because they, instead of letting me front run them, are probably creating a product that can compete on the blockchain. And I think every credit card company is going to have to do that, right? And could that happen today? No, because fees are too high, right? So all of this depends on these key catalysts. And if you believe that scaling is not possible, that's the ultimate bear case, right? Because you could say, look, all of what you're saying, Nikhil, depends on this key thing happening, which is fees declining. People have been saying that would happen for years. It's never happened. If it doesn't happen, I'll be wrong. But there are these concrete catalysts in the next 6 months to full year that should dramatically decrease fees. And when we see that, we're already seeing players adjust and adapt and move in anticipation of that. We're also we saw an investment bank list bonds on the Ethereum network. Again, why would they do that? It's not, in my view, it's not just pure speculation. These are serious banks, right? I think they're doing it because they think it's going to make them more competitive and that in some way they're going to accrue value to themselves by being a part of the Ethereum network. And then I think finally, I want to paint this bigger picture. You're a developer in this space. You have a creative idea and you create a product. I think every developer in the space is just tiptoeing around the fees right now. They're like, oh, okay, we could release this product, but fees are so high that, unless we have the best marketing run of all time, no one's going to use the product, right? That dynamic changes. And that's, I think, something that people are overlooking is there are a ton of funds going into the space to fund developers, right? But if you have fees that are incredibly competitively low, then the time from development to market for these products goes down to whatever it takes to actually develop the technology. And let me tell you, these developers, they're incredibly talented. That's not holding them back, right? What's holding them back right now is just does the product work? But if they can get a product that works and just throw it online immediately, the acceleration of the development of technology in this space is going to be unprecedented because there's this concrete barrier that's holding everyone back, that everyone is tiptoeing around, that no amount of money that you can just throw at it to solve, and that barrier is going to be removed. And it's gonna rip. And what's gonna rip specifically is adoption of the technology, right? So maybe the price reflects this very high level of adoption, but I argue at least to 30 to 50K, we're gonna see adoption come and quickly meet that valuation. And so I feel pretty safe buying at 30 to 50K for that reason.
Couple things. First, I talked about that Visa when that Visa announcement. I don't know how many months back that was, and like I said, I'm not a crypto expert by any stretch, but when I saw that, I did a show completely devoted as to why I was so bullish Ethereum. And I said, I may not understand exactly why they're doing this, but I understand the reasonings why they're trying to do this. Because just like you said, anytime a company like that announces something, you have to take note of it. I mean, when they're saying Ethereum now, the fact that they're even saying that word, that's bullish to me. And then you mentioned the bonds. That was Goldman. I'm pretty sure that was Goldman Sachs. I don't know. They've learned over the years how to turn a buck. Call me crazy. But, and when you hear names like that, it's quiet. It's coming out. It's still not, it's not mainstream yet. And I think at this point, hearing all the things that you put together, I mean, I threw that at you as saying, what's the sustainable about it? And one other thing that you said is so true when you say they're talented, because there are so many people, and I'm in the futures industry primarily my entire career. Some of the brightest minds in the derivatives industry are now moving into crypto. I actually met with, I play golf with a friend, somebody he knew was from MIT. He just graduated. What's he focusing on? Crypto, right? I mean, it's just the talent is there. And that's not something I really thought about too much, that it could start getting implemented as fast. But like you said, what's holding them back? Not talent. And that's key. That's
and
big.
not money either, right? They have the funding too.
Oh,
It's just the layer one blockchains need to be scalable, so that when it's 9 cents, I can tell my friends, I can be like, hey, just test it out. Like, throw $20 on it and see if you can send it, see how easy it is. Right now, they have to spend the whole $20 in fees. You know what I mean?
Yes.
So it's not plausible right now. But if that changes, it's kind of like, I mean, the same 2 layers. I'm arguing the price action is going to be different, because when you look at what moves price, it's supply and demand, that changes. And I'm also arguing just the fundamentals of the space are going to be different, because when you look at what moves consumers, it's actually going to be these, like, what fees do I have to pay to use the product? And that changes. And so everything about the space, there's just this big curtain over the future, and that curtain's about to be lifted in the next 6 months. And I just think we're going to see the results of that in price.
What did we miss in your thesis about this today? I mean, I know we covered a lot. I don't want to overwhelm everybody, but what did we miss?
Sure. I think the biggest thing that I just left out that it's worth talking about is the ETF, the Ethereum, the kind of coming of an Ethereum ETF. So recently, a lot of people have been waiting for a Bitcoin ETF, and by the same token, an Ethereum ETF. Recently, we saw them released in Canada. There were 5 Ethereum ETFs, I believe, that were released, and they got significantly higher inflows than people expected or were normal for a new ETF release. So we're expecting that to come soon. The SEC has dragged their heels on it. They're being very careful, which, sure, that's totally fine. But with the release of the Canada ETF, it gives them a data point where they can just watch. They can see how much damage, if you're worried about protecting consumers, how much damage was being done to consumers who bought into the Canada ETH ETF. And so my view is, within if they were released, I think at this point it was a month ago, 12 months after the Canada ETFs come out, there's going to be more than enough evidence that I think that will kind of force their hand, that there's no questions anymore. This can work in practice, and they're just leaving the U.S. investors kind of lagging behind. So honestly, for my thesis, it would work better if that ETF gets released later than sooner, because it'd be nice to, I talk about this illiquidity. It'd be much nicer for my thesis if in the middle of March, this ETF gets released in the context of really high illiquidity and a lot of supply being locked up, because it drives a huge amount of inflows of capital into Ethereum. Obviously, if it gets released earlier, it's still bullish short term, but just thinking about how to maximize the effect on price. But yeah, so wild card as far as timing, no clue when or if it will be released. There's good reason to think it would be released sooner rather than later, and I think that's why I included it. I think it'll be a part of the next 18 months story. And when it does, what that constitutes is forced buying, because when you buy an ETF, you're sending your money to the ETF provider, and they're turning around and buying Ethereum. So what that means is the ETF is highly liquid. I can send as much money as I want and take as much money as I want from the ETF itself. But the ETF provider has to then turn around whenever I send them money and buy something that's highly illiquid, which is the underlying Ethereum, to make sure their ETF tracks the price of Ether, right? And so at least at the beginning, what that means is there's going to be a huge inflow into these ETFs, and the ETFs are going to have to track the price. They're going to be forced to buy the price. They're going to be forced to buy Ethereum at whatever the market price is. And they're not going to care if it goes up, because they have to track that move. That's their job as ETF providers. So whenever you see a forced buyer, you kind of, my eyes perked up a little bit. I'm like, oh, that's interesting. And I think that's going to play out hopefully a little bit later in the game too. So when people are like, oh, it's delayed for another month, I'm like, great. because a lot of people think that's a bear, but I'm like, look, it's not that it's never going to happen. That's just not, I think, a reasonable perspective on it. It's just that when it does, it'll be better for my thesis. And yeah, I mean, I think that ties it up pretty much.
Final question for today. As a trader, I always look at where am I wrong, right? And a majority of the time it's price. I was actually in a trading room this morning and talking to traders about how I'm trading Ethereum a little bit differently than I am other things. I'm trading it as it's really an investment. So I don't even want to say it's a trade, although I am trading around a position because I'm trying to better my price. I'm trying to minimize some of the volatility because, as we saw over the past couple of days, it could be really volatile. So I don't want to be too stubborn and just all into something like that because I've been around long enough and I've blown up enough accounts to know that, hey, look, I could be wrong here. I don't think I am, but in order for me to stay in the position, I have to trade around it. But hearing you talk about everything today, what would indicate to you that you are wrong about this?
Yeah, so a couple things. I think there's fundamental metrics I'm looking at. If scaling solutions come on board and we don't see a reduction of transaction fees, or if these scaling solutions get delayed for far too long, and I start to see like that the reason they're being delayed is because they don't work, right? Then that'd be a significant blow to my thesis. The other thing would be that if EIP 1559 does not come on board, if proof of stake does not come on board, if we don't see those happen, I'd say I'm willing to give each of them like a month or two of leeway because normal delays are totally acceptable to my thesis. But if we see like a 6-month delay, a year-long delay, then look, maybe long-term the bull case is still intact, but I made an 18-month thesis and that'll break my thesis. So yeah, that's I'm going to be looking for kind of concrete evidence like that. And then the other thing is I didn't really dive into what are called the Ethereum killers, the like competition for Ethereum. But there are a few other products. They've seen very little adoption. And so if they start to steal a lot of market share, that would make me pay attention because that's, I guess, something that you have to watch.
Yeah, no doubt. I mean, I've been looking at some of those as well. I'm not going to mention which ones I've been looking at because once again, like I'm really just kind of doing homework on it. But I think Ethereum right now is holding the strong hand for them to make a move to really, this is a massive game changer as far as I'm concerned, because this is not just about price here that we're talking about as traders and investors. We want that to happen, but it changes the way society is going to be operating. I mean, this changes the way businesses are going to be operating. I mean, this is a really big thing. I mean, I can't, like I said, for me, I really struggle to even wrap my head around this, which is why I haven't talked too much about it because I'm really digesting all of this. And I, kudos to you because you just did such an amazing job of explaining some of the things that I really have been questioning. And I think that a lot of traders and investors out there, I mentioned this to you before we started to record today. I started buying this on hunches, the Visa news, just reading some tea leaves, not things I know a ton about. And it really started to resonate with me on how just everything works. It's just amazing what Ethereum brings to the table in terms of changing technology. I don't think that that's even talked about enough because there's just so many things. We talked about the smart contracts, and I'm glad you explained that today, that really is going to have, once it starts to get into play, have immediate impact, I think, on so many businesses, on so many things.
Yeah, no, it's so exciting to be a part of this, right? And it's crazy is I just got in on Ethereum, but I haven't really looked into the DeFi space more broadly because I think Ethereum is such a broad opportunity. But obviously my next stop is I got to look at kind of everything that this enables. There's so many different opportunities in DeFi apps and use cases that are kind of waiting to explode with retail adoption once this all happens. And so, yeah, there's just so much to look forward to.
No, absolutely. And I look forward to your next paper. And, I learned a ton from you with that paper. It was so great to meet you. Like I said, you just did a wonderful job with it. Tell people where they could follow you on Twitter. Like I mentioned to everybody, I will have it available to download on my website, but you also have a Substack, which I'm a subscriber to. Just give us all the details on where people can learn more about you.
Yeah, check me out at Twitter at Squish Chaos. And there's a link to my Substack as well on my profile. Not 100% sure where I'm going to go with that Substack yet, but if you're interested in kind of finding out whenever I write something new or have a new idea, please subscribe, and I'll definitely keep everyone there updated.
Yeah, and they should go and definitely check out, I believe it's your pinned tweet, and when they go through that and listen to other podcasts that you've been on. I know we covered a lot today, but I think it's important. You know, you've talked a lot about this lately. Like I even mentioned to you before we talked today, I heard you when you were on Twitter the other day. And, you know, I'm still new to that with Twitter where people are starting groups and they're talking. I think that's so cool. Basically going after Clubhouse, right? Isn't that kind of what they did?
Yeah, I think so. Yeah.
Right. And, but no, you were really good on there as well. I know that your future is extremely bright and I wish you all the best. And I can't thank you enough for taking the time to speak with me today on Futures Radio Show.
Thank you so much.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.